Hey there. This is a little video about Introduction to International Finance. We will cover the ways that finance is integral to all economies, and the global financial system is also integral to a globalized world. We'll look at the main regulation, the Glass-Steagall Act, that stabilized the financial system in the US in the 20th century. It is now gone. And we will also look at Roderick's trilemma and how it places serious limits on countries that want the following things: sovereignty, democracy, and globalization. Can't have it all. What is the international financial system? It's all sorts of different entities, banks, stock markets, and various financial instruments. Anything that allows savers and borrowers to sort of meet up. People that need to borrow money for investment and people that need to park their money to keep it safe until they need it. That's a huge instrument of economic growth. So the financial sector is massive. The Inside Job is a great video. It goes back a ways now, but it's the best of all the things I've seen to describe the catastrophe of 2008 and how the global financial system, following some deregulation, really kind of imploded, and the US really started it. Banks have such an important role because, like I said, they serve as the sort of intermediate bridge between savers and borrowers. And they also create money through their lending process. So banks are highly leveraged and they take your deposits and make them useful to other people in loans. And when they do that, there's some alchemy that they create, the increases in money supply, and that has effects on interest rates and all sorts of things. So banks are integral, absolutely necessary for any modern economy. And because governments have figured this out, and banks are not on their own very stable, governments have around the world figured out ways to sort of increase trust in banks by bailing them out when they fail, by creating deposit insurance, and all sorts of features that can that are designed to let people continue to use banks. And what this means is banks know they sort of have a get-out-of-jail-free card. They are so essential that they're going to get bailed out pretty much. At least that's what the last 20 or 30 years have taught us. Banks aren't the only players. We've also got stock markets who are a little bit riskier, right? They're not traditionally insured or backed up by the government, and they are inherently riskier investments when you buy shares of companies. Bonds and derivatives are other sort of instruments that help people raise money when they need cash for some expansion or new endeavor, or just a new car or new home. Derivatives, if you look at the 2008 financial crisis, end up being a pretty important part of what happened. And new financial innovations sometimes are hard for regulators to keep up with and understand how risky they can be. And Ha-Joon Chang and many, many other economists have credited the 2008 meltdown globally to deregulation and excessive riskiness on the part of banks. So the bummer about financial crisis-led recessions are that those are usually the worst and longest and steepest recessions. And in our case, in the U.S., it led to so much anger that the Tea Party was sort of started and empowered, and that turned into a rage populist machine that has some roots in what we see today in the U.S. polarization. The Glass-Steagall Act is the main financial regulation for the 20th century. It was born in the Great Depression, so in the middle of another catastrophe economically, trying to protect from bank failures. The mechanism by which it did that was to separate investment banking from commercial banking. Investment banking is where banks that are more into stocks and more into riskier investments. They're less available to the average person. So the average person's more likely to be dealing with commercial banks. Wherever you bank is most likely a commercial bank. Some banks, especially since before and after the financial crisis, have merged as investment and commercial banks together. The danger of that is that these banks now can are holding so much assets. If something goes sideways and the oil or assets that they're holding sloshes all together, it can capsize the whole tanker, or in this case, the global economy. So if you take on too much risk and the thing goes sideways, it's better if there's a bunch of different banks separated from each other. For instance, commercial banks are separate from investment banks, and they don't play together, and therefore the asset loads that they have are just not nearly as big. So compartments were put into the tankers to make them more stable. This lasted until 1999. So what we see in the second Clinton administration is a removal of the Glass-Steagall Act and replacement by something that was asked for by the banking industry. They wanted less regulation on themselves. They wanted to be able to play in any markets they want. And so investment banks are now allowed to play with commercial banks. And basically, we removed the compartments and the tanker capsized. So the deregulation of financial markets basically ended that era of compartmentalization and safety. What had happened is that you had a chairman of the Federal Reserve really pushing hard, really since the 80s with the Reagan and Thatcher deregulation pushes. In that same vein, trying to get rid of regulations on banks, and they finally got through. And so Clinton, a pro-business Democrat, basically allowed the merger of these banks, and we saw what happened 9 years later. So most economists see the need for more bank regulation, not less, especially because they take taxpayer money in the form of deposit insurance. So the U.S. taxpayers are on the hook for what banks do. If they fail, it's U.S. taxpayer money that is used to bail them out. So it makes sense that in exchange for that deposit insurance and the billions of dollars we've already paid out to failing banks, that we would ask for some regulation. So what's difficult is that the financial industry is very powerful, very well funded in lobbying. So they get a lot of what they want and have been getting what they want for a couple of decades now. But that makes people angry, and that's some of where the populism is coming from. So the reason for effective regulation is that it is encouraging macroeconomic stability, considering all the variables that make global economic stability very fragile. It's something that is probably needed. Very difficult to have financial capital be able to move around the world as quickly and easily as it does without regulations. So what the regulations could be: capital requirements, where banks are required to put up more of their own money, transparency mandates, oversight of products. All of these things banks regularly resist regulation for. And it is true that when you overregulate, banks are not allowed to innovate as much. So financial innovation is an important thing, because you always want to find new ways for people to spread risk, to diversify, to invest in products like the U.S. housing market. That was a big deal. People wanted to invest in it in the financial crisis, before the financial crisis, rather. But balancing that need for innovation with safety is always going to be a central challenge. So let's turn our attention to Roderick's trilemma, or the impossibility theorem. This is the idea that there are three things that many countries want, and the things that they want generally fall into these categories: globalization, sovereignty or control over their own stuff, and democracy. Turns out, difficult to have all three at the same time, according to Dani Rodrik. So there's a great video to check out that is linked in your Canvas. It's a 4-minute video on Roderick's trilemma. But here's my stab at it. The three elements are globalization, global economic integration, right? Then you also have national sovereignty, and then you also have democracy. All three have been, for a long time, considered to be really important elements in human flourishing and economic growth. Countries regularly decide how much of each to handle, and their size and their culture and language and natural resources sort of help determine it as well. But countries are usually looking for some element of each of these aspects. But look what happens if you get too greedy and you try to get them all. If you are looking to be globalized and have a democracy, that's going to mean that you have less control over your trade laws, your sort of domestic politics as well, a little bit, because you will have sort of opened yourself up to the rest of the world. If you choose globalization and sovereignty, that's going to put pressure on your democratic accountability. And if you do sovereignty and democracy, that's going to limit your ability to do globalization. Here are some examples. The EU has given up, countries within the EU have given up a lot of their national sovereignty because they're trying to globalize, have the benefits of trade, and while also maintaining democracy. And if you are globalized and you want to maintain more of your own control over your own economy and your own military and laws and everything, it can cause you to sort of crack down a little bit more on your democratic backlashes when they occur. You can also lean into sovereignty and democracy, but that is going to limit the amount of globalization you can do, usually. If you have people, the voice of the people, and the control over your own economy, often that will yield protests against globalization and questions about workers' rights abroad, etc. And so you get sort of some pushback against globalization. You may be seeing some of that right now. For instance, the European Union emphasizes globalization and democracy, but obviously has national sovereignty challenges. China would be strong in globalization and sovereignty, but we know about the democracy part. And the U.S. leans towards sovereignty and democracy, and we fight a lot about how much globalization to have, especially now. And we're also having fights about other stuff too.